All right, let's talk about Manhattan Associates. They just dropped their latest earnings report, and on paper, wow, it looked like an absolute home run. But then you look at the stock price, and it tells a completely different story. So today, we're going to get into the anatomy of this earnings fade and figure out exactly what happened. This is really the million-dollar question, isn't it? When a company beats expectations and raises its guidance, but Wall Street still punishes the stock, it's a classic head-scratcher. Manhattan Associates just gave us a perfect case study. So when does good news get treated like bad news? Let's unpack it. So first, let's just look at the headline numbers. By pretty much every traditional metric you can look at, this was a fantastic report. I mean, the kind of report that should have sent the stock soaring. The numbers really do speak for themselves here. Let's start with the bottom line, earnings per share. The company delivered an adjusted EPS of $1.21. Now, the consensus on the street was for $1.11, so that's a solid 10-cent beat. A really great start, no doubt about it. And what about the top line? Well, revenue came in at $270.4 million. That was comfortably ahead of the $264.7 million everyone was looking for. So you're talking about a beat of almost $6 million. So far, so good. Okay, now this is where things get really interesting. For a company like Manhattan, you have to look at their cloud subscription revenue. This is their most important segment. And it was up a whopping 20% year over year. For a software business, this is the golden metric. It shows that their big shift to a recurring revenue model is working, and Wall Street absolutely loves to see that. And if you want a little peek into the future, you look at this number. This is the remaining performance obligation, or RPO. You can basically think of it as the total value of all the contracts they've already signed but haven't billed for yet. It grew by an incredible 25% to $2.2 billion. This signals that future demand is super strong. So look, on every key metric, they killed it. So you can imagine, with numbers this strong, management came out on the earnings call feeling pretty good. They were ready to tell a very, very optimistic story and lay out a clear bull case for where the company is headed. They really hammered home three key things. First, they had record cloud bookings, which just proves the sales engine is absolutely firing on all cylinders. Second, they're not sitting still. They're pushing hard into innovation with new AI agents to help their customers. And third, they put their money where their mouth is, aggressively returning capital to shareholders. We're talking a $75 million buyback in the fourth quarter alone, plus a brand new $100 million authorization. That's confidence. All right, so you've got the great numbers, you've got the confidence story from management, so let's see how it all came together in the market. Or maybe I should say how it all fell apart. Because despite everything we just saw, the market gave them the cold shoulder. The reaction was not what you'd expect. I mean, listen to the CEO, Eric Clark. You couldn't ask for a more direct, more bullish statement. He said, "We ended the year strong, achieving record cloud bookings in the fourth quarter." It's crystal clear, and you know what? At first, the market actually agreed with him. Just look at this whiplash. It's wild. Right after the report hit the wires, the stock shot up almost 5% in after-hours trading. Everything's looking great. But then the music stopped. By the end of the next full trading day, the stock had done a complete 180, closing down over 5%. That entire initial pop was gone, and then some. So what on earth did the market see that completely soured the mood? Well, the answer, as it so often is in these situations, wasn't in the numbers they just reported. It was buried in the forward guidance. When all those analysts and investors started digging into the outlook for the next year, they found something they really, really didn't like. This right here, this is the smoking gun. Take a look. The revenue guidance for the full year was, well, it was fine. 5 to 7% growth, nothing to panic about. But then look at the adjusted earnings per share. The guidance there implies growth of basically 0 to maybe 3%. For a high-flying, premium-valued software company, flat earnings growth is a massive, massive red flag. See, when you pay a high price for a stock, you're not paying for today, you're paying for future growth. And guidance for flat earnings just does not justify that premium price tag. It hints that either some major margin pressure is on the way, or maybe that Q4 beat wasn't as high quality as it looked on the surface. All right, so let's put it all together. You've got the strong quarter, the bullish talk from management, but you've got that one huge red flag in the guidance. So, what's our call on the stock from here? Where do we go? We're slapping a market perform rating on it. And the logic here is pretty straightforward. All the good news, that awesome, successful cloud transition, it feels like it's already baked into the stock's high price. And that weak EPS guidance for the coming year,
It puts a pretty firm ceiling on how high this stock can go, at least until the company can prove it can get those profits growing again.
So what's the play here? Well, our thesis is that the stock is probably dead money for a little while, just stuck in a trading range. Now, what could change that? There are two key catalysts to watch. First, can those new AI agents they talked about actually start bringing in real, tangible revenue? And second, can their cloud bookings stay strong even if the broader economy gets a little rocky? The biggest risk, of course, is a major slowdown in enterprise software spending. If that happens, it's going to hurt everyone, but it'll especially punish high valuation names just like this one.
This is not financial advice.